Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Hope you're having a good day. Look, we're financial advisors, but we like to focus on data. And one of the things I'm going to talk about today, and we're going to start doing a series of these for our customers, and maybe we'll throw a few out here publicly as well, is can you beat the stock market? And if so, how? Where's the data to support it? Because so many people say you can't beat the stock market, and it's a really touchy subject. So we're going there, just so you know. We're going to start, but I'm going to share the data with you. See, my opinion doesn't really matter. I mean, some of you may hold it in higher regards than others, but at the end of the day, it's just my opinion. That doesn't really support anything. It's a lot like when you watch sports shows and they're saying, oh no, I think these guys are going to win. Oh no, these guys are going to win. It's fun to talk about, right? I mean, we have a little fun rivalry, a little back and forth, but at the end of the day, it's just opinion, and it really doesn't make much of a difference at all. We want to back things up with fact. Well, lucky for you guys, the stock market is 100% quantifiable, right? We can actually, if that's a way to say it, we can actually go and justify any decision we want to make. And so I want to share with you how we came up with things today. Now, I'm not saying this is perfect. Follow along with me. If you see ways to improve, I'm happy to do these again. I basically just want to leave my opinion out of it and show you how we came up with a study here to see what you think. And we're going to start with mutual funds. Do you think that mutual funds can actually beat the performance of the stock market? Well, the first thing we have to do is we have to address what is the stock market, right? What are we going to do? Most people use the S&P 500. They'll call that the stock market. In truth, there's a lot of different indices that may fit you even better, but most of the books and sort of financial gurus out there focus on the S&P 500. It's all marketing, right? It's just better marketing than any other index. But at the end of the day, the S&P 500 is a portfolio made up of stocks with a strategy or a description, an objective that has been publicized to the markets. Mutual funds are portfolios of stocks with objectives that are publicized to the market. Their objective may not be to beat the market, but they will tell you how they comprise themselves so you can see if it's even possible. So at the end of the day, can you beat another portfolio? That's the question. The stock market's just a portfolio. Can we beat it? Of course you can. I mean, look, Dave Ramsey says he beats it every year with that mix of 4 funds. We're actually going to cover that as well in another video. But so here we go. Let's dive in. I want to show you every last little scrap of detail so you can make the decision for yourself. And by no means am I suggesting that any of the funds that we do happen to find during this scan are suitable for you. So I'm definitely not making recommendations, but I will go over the specifics here. And to do that, we're going to dive over to the charts. So follow along with me up here at the top. First thing we did is we said, let's look at all mutual funds. There are 66,831 mutual funds. Quick question. Out of 66,831 participants or mutual funds, do you think that one of them could beat the stock market? I mean, surely one of them has got to be able to do this, and that being their goal as well. Well, we have to filter these out somehow, so we set a little range of criteria. And let me know if you think that there's something else we should add to this. We can expand on it, of course. We took out exchange-traded funds. That wasn't very many, but the focus today is on mutual funds, so we wanted to get rid of exchange-traded funds. We also took out unit investment trusts. They're not typically popular for people that are looking to do this sort of thing, and it also makes our search much easier. We could leave them in there if you really wanted to. It really wouldn't make much of a difference. We also said, hey, if they're not here in the U.S., we don't want to bother with them. Take out all the Canadian foreign ones, and then the one fund from Bermuda. I'm not even sure which one that one is, but you could see that we went from 28,413 to 28,412, so there's got to be one in there somewhere. We decided just leave it out. It's got to be here in the States. It can be an international fund, of course, but we have to be able to buy it here in the States, U.S. Based. All right? So we have filtered our funds already down to 28,412 different choices. From there, we said, look, we don't want a mutual fund that's only been around for 5 years. That's not enough history. That doesn't tell us enough going forward. So we said, look, it's got to be at least 20 years old. So the following examples will show mutual funds that fit the above criteria that are at least 20 years old, and the oldest one being 119.74 years old. That then filters our search down to 4,937 different funds. Now, the S&P 500, if we go back 20 years, I'm going to go to 10 years here, and then I'm just going to change this to 1999. And we're going to show what's the average annualized returns for the S&P 500. You get, it's up here in the top right, you get 6.05%. So over the last 20 years, which is the base of our study here today, the stock market has returned, let's see if we can go a little higher. Sorry, you can't see the bottom there, but this is a 20-year chart. 6.05%. So that's the criteria. That's the benchmark that we have to beat. If you invested in the S&P 500, all dividends included, and I can show that actually if you want to just look at the S&P 500 without the dividends, just the raw return over the last 20 years, only 4.03%. And that makes sense. Average yield of about 2.2%. And so this purple is really what we're looking at here. We want the total return, all things included in the mix. So I'm going to delete that so you can just see the difference there. Okay, so we've got to beat 6.05% on an annualized basis, meaning on average, at the end of a 20-year period, we just have to do better than that. So if I go back to my screener, you can see that we've said it's got to be greater than 6.05%. Anything above that we'll take. Of course, we're going to factor in fees along the way, but to start, that gets us in the right place. All right. We can go all the way as high as whatever one has the best returns, and that narrows our search down to 74 different results. All right. So let's take a look. If we go down here at the bottom, what I've done is I've sorted by column so you guys can see that everything is included as we wanted. Years since inception, meaning it's got to be at least the 20 years old, which is above there. So first one here, 23 years old, 21 years old, 20, and so on. You won't find any list, any name on here that's younger than 20 years old. I think that's fair. You know, we could probably stretch that out too a little bit further to even further narrow it, but this gives us a good list. All right, average annualized 20-year price returns have to be better than 6.05%. And so you can see here, this is ranked in order. So we're going with the one that has the best returns relative to the ones that have the worst returns. However, if I just resort this list, notice that it's still above the 6.05. So our worst performer here still beats the market, but of course there's maybe a fee involved in there. You got to factor that in as well, and that's why we put the expense ratio and any performance fee if there happen to be one. So let me just resort here by the best performers. There you go. So we'll just move through the columns here. Dividend yield, we put that in there. That's the current one over the last 12 months. Trailing 12 months is what TTM means. So it's not able to factor the entire lifespan. We're just assuming this is the dividend yield going forward. It also has the expense ratio. That is everything. Actually, we decided to put everything all into one instead of categorize them by administrative fees, 12B1 fees and everything. Just give us the entire amount there. And a performance fee is not very common, but they can be on some funds, and there is one on here somewhere. The Canada fund takes a 0.2% performance-based fee there. So we just wanted to put that in there just to be as transparent as possible. I also went through and I said, well, what's the max drawdown? Meaning, what's the worst I had to sit through from a high to a low? Max drawdown just means that whatever the product is or the market is going up, going up, going up, hits some point and then starts to fall. What's the biggest drop that it's had? So you can see this first fund here, Russian International Fund, 90%. That's pretty crazy, actually, 90%. Just to give you an idea, the S&P 500's max drawdown, all-time max drawdown, 55.25%. So 90 is a bit high. Anything in the 50s is understandable. Considering that it's beating the market, you'd expect it to be a little bit more volatile, but 90 is maybe a little much. I would probably just cancel this one out. It costs you 2% anyways, more volatility. You might like those returns, right? You might look at this and say, for an average of 11% a year, I don't care how much it wiggles around. I know that at the end of the day, that's still the best performer, right? Because it's given a 2.13% yield, dividend yield, at least at the moment. So that offsets the expense ratio. I'm looking at about an average 11% gain. That might be okay for some of you, but that'd probably be more volatile than most would want. Anyways, in standard deviation of those returns, the monthly returns, we broke it down into just to show like how far apart your returns are. And in this case, since it's a more volatile fund, you would expect that the returns would be more spread out. And that's just a fancy way of saying that. Okay, so at the end of the day, you can now look through a list and say, okay, well, these are all funds that beat the market. There's no opinion here. These funds beat the stock market repeatedly, going back over 20 years. So now it'd really just be up to you to look through and say, do I want to participate in any of these? Now notice that some of them are index oriented, right? Oh, that's interesting. Why would a small cap growth index beat the S&P 500? Right? Bet you didn't know that was possible. It actually very much is. So you see that some of these are more sector-based, healthcare, IT services, FBSOX and such. They beat the market, just more aggressive growers. Small dividend, because it's a growth fund there in the tech sector, more tech stocks. Small expense ratio, max drawdown is less than the overall stock market, but you get performance that's better than the stock market. That's not bad. And pretty tight here on the standard deviation of overall returns. Let's take that one as an example, actually. What's it called? FBSOX. So if I go in here, FBSOX, now it's going to look a little different in terms of return. You're actually going to see that it shows annualized returns a little bit higher. That's just because we're doing year over year, whereas here we're doing current. This is actually up to the date. So it's close, but there's going to be a little difference there. All right. In the long run, you are seeing the total return of the S&P 500. You're also seeing the total return with dividends included, which are not much, but for this particular mutual fund. So this is, again, not a suggestion in any way. It's just to show the difference that, yes, you do beat the stock market. We're going back over a 20-year period. You can see by my date up here, we went from today's date, 9/2, to 1999, just to go back and include a 10-year time period there. So that's really it. Again, none of these are necessarily suggestions. It's just a way that you can actually confirm to yourself, yes, you can absolutely beat the stock market. If that's your goal, the S&P 500, you can absolutely beat it by just being selective about the funds that you look at or the combination of funds that you look at. So it sort of puts some of this to rest. Now, again, this is just a starting point. We're going to dive into this in great, great detail. We're actually going to do a class for our customers on the Dave Ramsey funds so we can actually break down what he's telling people, show the funds that's very likely he's actually choosing, and see how you can go through and actually pick those. At the end of the day, yes, you absolutely can beat the stock market. Remember, the stock market is a man-made portfolio. That's the takeaway here. Could there be a possible better arrangement of stocks to generate better returns in the long term, not just for 1 year? Absolutely, there sure can. You may have to experience a little bit more volatility, but as long as that's okay with you, then that's the case. The other side to this is it may not be that you need to beat the market. Just because a mutual fund doesn't beat the market doesn't make it bad. It may be offering something completely different. Just because an investor, a hedge fund, a financial advisor, someone doesn't beat the markets, it may be because they're not supposed to, right? It may be the goal or a different goal for their customers. But anyways, I'd enjoy your feedback on this one. Let me know where you think we can improve or some studies maybe you'd like us to run. We now officially have the data of every single financial product on the planet for its entire history, as well as every economic indicator as well. So there's no study we can't run. So we're just starting to really pull the what do you say? Pull the cover off this thing and see what we can do. If you enjoyed the video, I'm supposed to tell you to hit the thumbs up button or hit the subscribe button. That does something, and I appreciate whatever it does. We'll be back later today to do the stock market update. It's a 5 o'clock show that we do, just cover the stock market, the good, the bad, and the ugly, let you know what's going on there. And of course, we try to always focus on the data rather than opinion. Opinions are fun, but at the end of the day, we need some data so that you can actually get a takeaway from this as well. Hope you enjoyed. See you later.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.